Welcome to Module 7. Today, we are rebuilding technical analysis from first principles. Our primary objective for this session is to move away from the buy and sell signals you see in textbooks and develop a professional framework for understanding market movements. By the end of this video, you will be able to distinguish between lagging and leading data, identify real market structure, and understand how institutional liquidity drives price. We are going to start with a hard truth. The way most retail traders are taught technical analysis is fundamentally flawed. If you've ever felt like the market hits your stop loss and then goes in your direction, or that a golden cross happened way too late, you're experiencing the gap between retail theory and institutional reality. We aren't here to learn patterns. We are here to learn how the market actually functions. Finally, let us look at the referral information. For the best trading experience, you can optimize and analyze your live trades on the Dhan app. Use the referral code EJZZI96380 to open your Dhan account. By using this affiliate link, I may earn a commission at no extra cost to you. Make sure to subscribe to IndexOrbit for more professional insights. Let's address why most retail technical analysis fails. It often comes down to one word: lag. Most popular tools, like moving averages, MACD, and RSI, are derivatives of price. This means the price has to move first, then the math happens, and only then does the indicator change. By the time a crossover happens, the smart money has already entered or is even looking to exit. In the Indian markets, this is even more pronounced. We deal with lower liquidity in mid-caps, algo-driven expiry days, and high volatility. Textbook patterns often fail in Nifty or Bank Nifty because institutional algorithms are designed to exploit the very buy signals retail traders are looking for. On expiry days, price moves aren't just about supply and demand, they are about delta hedging and liquidating retail positions. We need to make a clear distinction. Lagging indicators like moving averages, MACD, and RSI tell you what happened. Leading data points like price action, order flow, and volume give you a hint of what is happening right now. Our philosophy in this module is simple. Price is our primary tool. We use a framework, not a buy signal. We are learning to read the market's story, not just wait for a line to turn green. And as you see on the screen, for a professional trading experience, you can optimize your trades on the Dhan app. Use the referral code EJZZI96380 to open your account and subscribe to IndexOrbit. If we want to avoid the trap of lagging indicators, we must focus on the only data point that happens in real time: price. We call this price action. Market structure is the skeleton of price action. At its most basic, you've likely seen the concept of trends. In a bullish market, we see price making higher highs and higher lows. In a bearish market, we see lower highs and lower lows. However, the retail trader usually stops here. To trade like a professional, we need to understand how these trends change. There are two critical concepts you must master: break of structure, or BOS, and change of character, or CHOCH. A break of structure occurs when the price continues the existing trend. If we are in an uptrend and price breaks above the previous peak, that is a BOS. It signals trend continuation. A change of character is different. It is the first sign that the trend might be ending. If price is in an uptrend making higher lows and suddenly it crashes through the most recent higher low, the character of the market has changed from bullish to bearish. Take a moment to look at this. Retail traders often try to sell the top while the structure is still making BOS to the upside. Professionals wait for the CHOCH to confirm that the environment has actually shifted. To understand why a change of character happens, we have to talk about liquidity. Think of liquidity as the fuel the market needs to move. In the markets, liquidity is simply a cluster of orders. Most retail traders are taught to put their stop losses just above a double top or just below a double bottom. Here we see price hitting a ceiling twice, forming equal highs. Retail traders see this as resistance and stack their stop losses right above these peaks. But then, price spikes above the peaks in a sweep, triggering those stops, before crashing down violently. Big institutions like banks and hedge funds need to fill massive orders. They can't just buy a million shares without moving the price against themselves. To get a fair price, they need to find a large pocket of sell orders to buy from. And where are those sell orders? They are the stop losses of the retail traders who went short at that resistance level. Price doesn't move randomly. It often hunts these liquidity pools. This is why you see a fake out or a stop hunt, where price briefly breaks a level, triggers the stops, and then reverses. Common liquidity areas include equal highs and lows, obvious swing points, and the previous day's high or low. When you look at a chart, don't just look for support. Ask yourself, where is the money sitting? Professionals wait for the liquidity to be swept before they even consider entering a trade. This is the difference between being the liquidity and trading with it. Now that we understand liquidity, let's redefine how we look at the levels where price reacts. Beginners often draw thin lines on their charts and call them support or resistance. But in a live market, price rarely respects a single exact number. If you think Nifty has support at exactly 18,500, you will likely be stopped out by a minor fluctuation. Instead, we must think in zones. A zone represents an area where a high volume of orders was previously transacted. This brings us to a crucial distinction: supply and demand zones versus classical support and resistance. Classical support is where price bounced. Supply and demand zones are where the move started. Specifically, we look for institutional order blocks. An order block is a specific candle where institutions placed heavy orders, causing an imbalance that led to a sharp price move. Price often returns to these blocks because the big players may have unfilled orders left behind. When price enters a demand zone, a lower order block, we look for a reaction. When it enters a supply zone, a higher order block, we look for a rejection. To make this objective, we use the volume profile. Unlike a trend line you eyeball, the volume profile shows you exactly how much volume was traded at each price level. The POC, or point of control, is the price level with the highest traded volume. The value area, high and low, shows where 70% of the volume occurred. These aren't just lines, they are psychological and financial anchors. If price is below the POC, the market is effectively on sale relative to where most business was done. If it's above, it's considered premium. Finally, let's look at the image provided. It represents IndexOrbit, a tool for optimizing and analyzing live trades on the Dhan app, offering a referral code for new accounts. We have spent a lot of time deconstructing why retail tools fail. Now, let us talk about which indicators actually deserve a place on your chart. Remember, we use these sparingly, as confirmation only, and never as a primary buy or sell signal. The most powerful tool for an intraday trader in the Indian markets, especially for Nifty and Bank Nifty, is VWAP, the volume-weighted average price. Think of VWAP as the true average price of the day. Unlike a simple moving average, VWAP gives more weight to price levels where more shares were traded. Institutions and large funds often benchmark their performance against VWAP. If a fund manager buys a large quantity of Reliance below VWAP, they have done a good job. Because institutions use it, price tends to gravitate toward it or react strongly when it is far away. If the price is trending above a rising VWAP, the bulls are in control. Next, we look at raw volume. Volume is a leading indicator because it shows the intensity of a move. A price breakout on low volume is often a trap or a fake-out. But a breakout accompanied by a massive spike in volume tells you that the big players are participating. In the Indian derivatives market, there is one more super tool: open interest and OI change. Open interest tells us the total number of outstanding contracts. If the price is rising and OI is also rising, new money is entering, and the trend is strong. If price is rising but OI is falling, it is just short covering, a much weaker rally. In Nifty, watching the PCR or put-call ratio and individual strike OI can tell you exactly where the walls are for the weekly expiry. Lastly, always remember to check the referral code EJZZI96380 to open your Dhan account and optimize your trading experience. To truly rebuild your technical analysis, you must also know what to discard or deprioritize. Many traders clutter their charts with oscillators that provide conflicting signals. Let's be clear, this isn't about indicator bashing, it's about using each tool for what it is actually good at. First, let's look at the RSI and stochastic oscillators. Retail textbooks tell you to buy when these are oversold below 30 and sell when they are overbought above 70. In a strong trend, a market can stay overbought for weeks while the price continues to skyrocket. Using these as entry triggers is a recipe for disaster. Instead, only use these for divergence. If price makes a new high but the RSI fails to do so, it's a warning that momentum is slowing. But it is still not a signal to sell by itself. Next is the MACD. The MACD is a moving average of moving averages. By its very math, it is twice removed from the actual price. By the time the lines cross, the move is often halfway over. It is useful for seeing the general swing of momentum, but terrible for timing an entry. Finally, the famous moving average crossovers, like the golden cross. These are excellent for defining the long-term trend context. If the 50 is above the 200, you should generally be looking for buy setups. However, using the moment they touch as your entry signal usually means you are entering at the most crowded and late stage of a move. Use price action to enter, volume to confirm, and indicators only to provide a secondary check on your logic. Finally, let's look at the subscription info for IndexOrbit. You can use the referral code EJZZI96380 to open your Dhan account and optimize your live trades. To wrap up our first principles approach, let's look at a practical example of how these concepts come together on a chart. And I'll explain the specific toolset we've discussed today. In this scenario, we don't just buy because it's at a level. We wait for price to hit our demand zone, the institutional order block. We look at the bottom of the chart. Is there a volume spike? If yes, it means the smart money is active. We then wait for a change of character on a lower time frame to confirm the shift in momentum. Finally, we use VWAP as our first target, or as confirmation that the intraday trend has turned bullish. As you begin applying this framework, you'll need a platform that provides these high-level data points like volume profile and real-time open interest. The image you see here is a recommendation for the Dhan app. It highlights a referral code, EJZZI96380. Dhan is particularly popular among Indian traders because it offers advanced features like trading directly from TradingView charts, which makes identifying these zones and order blocks much easier. Using the referral link or code helps support the creation of these modules at no extra cost to you. Remember, technical analysis is not about predicting the future. It is about building a high-probability framework based on where the money is moving right now. In this module, we've learned why retail indicators lag and how to avoid that trap, how to read market structure through BOS and ChoCH, the power of liquidity and supply and demand zones, and which tools, like VWAP and volume, actually matter in the Indian markets. Take these principles to your charts today. Don't look for patterns. Look for the story the price is telling you. See you in the next lesson.